Hey there, everyone. Happy Tuesday, November 25th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of classic, rainy, wet, little chilly, but awesome fall day here in Redmond, Washington. Hope you guys are all doing well. Hope you have lots to be thankful for. Today, on November 25th, I am thankful for Mrs. Keller. Today's 25 years of marriage, which is a pretty awesome milestone. I am proud of many things in life, but that is one I'm especially proud of. So happy anniversary to me and Mrs. K. With that in mind, let's talk about the market giving us a nice anniversary gift with another big upswing, which you'll see as we look at the charts together here. Today had a very similar configuration to Monday's session, right? Sort of a weaker, kind of choppy open, but then a nice progression higher. Now, yesterday we kind of stalled out in the afternoon. Today, nice kind of drift higher in the last hour of trading. Ended up pushing the S&P almost to like 67, 80, almost got up there. It did close around 67, 65, up on almost 1% from yesterday's close. As we talked about, right, given the miss on NVIDIA last week with earnings, the significant downdraft last Thursday, given the test of our line in the sand at 65.50, kind of the base case in that scenario is even if the market eventually resolves lower, you usually have a counter trend move here, often a little more lighter volume, especially in a holiday week. Very rare that in a shortened holiday week with limited data that the market would just kind of roll over. It's usually kind of a drift higher kind of situation. And then next week, beginning of December, ends up being kind of the next big move. We'll see what happens. So I think this week, to be honest with you, kind of makes sense. Whether you're bullish or bearish, this is kind of the reasonable expectation, right? If you're bearish here, this kind of bounce off of a very clear support level makes a ton of sense to me. If you're super bulled up, this feels like a nice kind of recovery move. So I think what happens after this initial bounce higher is where things start to get a lot more clear. And to be honest with you, things that have not looked as attractive in October into November, particularly measures of breadth, I would argue would have to really meaningfully improve. And while I will not say that we've seen a ton of that, we are seeing, maybe some of that. And I have some of the charts to show you how the breadth has actually gotten a little bit better here, particularly on today's session. It actually wasn't too bad of a breadth day. I just want to make sure I got all the charts on here. I didn't. So I'm going to grab one here. And then, hey, you'll watch me work. We're going to go to the market recap here as I edit a chart list. What I meant to do was what I'm going to do right now. I meant to go to this place right here. And I meant to go to this chart of breadth, which is here. And I meant to save this to the chart list. And we're going to do it right now. Chart this, and we're going to call this 150. There you go. Done. All right, let's get back to the market recap. So if you're new to the show, I usually don't spend time putting my charts together. I'm usually a little better organized than that. But hey, it's a shortened holiday week, so we're going to take the best we can get here on Chart This. And I promise to be refreshed and ready to go a little better here next Monday, the beginning of December. But for now, here's what we'll do. As always, we'll talk about market conditions here. We'll do a quick market recap looking at the dashboard here on stockcharts.com. We'll look at the market carpet, which is a heat map where we'll talk about some individual stocks, sectors, group themes, some of the things that stand out in terms of movements today. And then we'll look at some charts together. As always, I've gotten some really great questions from you guys here in the last couple of weeks. Obviously, this is a choppy time in market conditions. Volatility has been fairly elevated, although the VIX did come down today. So if anything we're talking about here today brings a question into your mind, please take a moment, use the comments section on our YouTube channel. I'd love to hear your questions and hope to answer them in our next mailbag episode. All right. By the way, I think I'm going to do a mailbag episode on Friday. Don't hold me to that, but that's my general plan here. Probably take tomorrow off for Wednesday. Hope you have a wonderful Thanksgiving holiday. We are going to be putting on a different video tomorrow, looking at different scenarios for the NASDAQ 100. I would encourage you to take a look at that over the long weekend and give some thinking to that. I think it's a really good time to do that. Friday we'll do a mailbag episode, and then Monday we'll be back with the show in its normal format. All right, with that in mind, S&P up today, 0.9%. That's 67, 65 and change. The NASDAQ composite has now pushed above 23,000. It's up about 0.2%. The Dow ended up being the top performer of the three major U.S. indexes, up 1.4%, now over 47,000. Mid caps and small caps both did really well. And check out the S&P 600 small cap index, which was up the most of all, 2.6% to the upside. So it really is more, I mean, it really is a pretty impressive outperformance day for mid caps and especially for small caps. A lot of that ends up being the sector performance, right? If certain sectors are stronger, small caps just have much bigger weights in those sectors. And if certain sectors like technology lag, there's just not as much tech or certainly as much of a weight in technology in the small cap indexes. And that's why part of why you're seeing small caps move higher. But, you know, as a risk on move, pretty encouraging to see small caps outperform. That's something I've been talking about with many guests on my podcast for the course of the year. We're still waiting. Maybe this is the beginning of that. We'll see. Volatility coming in here, and I'm happy to tell you the VIX is now below 20. That was one of the biggest red flags that we've observed in the month of November, is the VIX spiking above 20. When that happens, what that's telling you is that the options market is pricing in much bigger day-to-day swings on the S&P. It's literally how you can translate the value of the VIX. So if the VIX back below 20, that means days like today with the S&P up 0.5%, 1%, should be more the norm, and big percentage swings should be pretty rare, is what the VIX under 20 would tell us. So that's an encouraging sign here, because if volatility can remain low, that means the options market at least is not pricing in a lot of fear, is not pricing in a lot of uncertainty. It's more of a stable, low volatility environment. The VIX went down about 2 points today. Yesterday finished just above 20. Today we're in 18.5 or so. So if the VIX can remain below 18, that would be very, very encouraging. And again, I think the big question mark will be after this holiday week and into next week. I think not that this is a total throwaway week, but holiday weeks, it's very easy to read a lot into big moves you see in a holiday week. I would just tell you, listen, holiday weeks usually have lighter volume, a lot of people taking time off, usually more positive than negative. I don't have the hard stats to back that up, but this is now my 26th holiday season of going through. That's just usually what happens. So I'm telling you that from experience, not from any data I can show you. So before you ask me, how often is it up during a holiday week? I don't have the data. I'd love if one of you has a great source of someone that has done that legwork. I'd love to see it. If I had an assistant, that's something I would task them with doing right now. So we'll see. All right, looking at the bond markets, we can see bonds generally drifting higher this week. The TLT up another 0.25%. 10-year yield is right at 4%, and that's really just been steadily declining. One of the charts that we'll talk about with a nice breakout today, Lennar, homebuilders, right, actually starting to bounce higher, and lower rates are a big part of that story. Remember, lower interest rates, lower 10-year yield means your house, your mortgage, way more affordable. And so that generally, home builders tend to have a great tailwind when rates are going down. The chart of the 10-year yield, as we'll see in a little bit, kind of in a nice consistent downtrend channel. 5-year points around 3.6%. Long bonds now below 4.7%. Dollar drifted a bit lower, not too bad today. Looking at the commodity space, kind of a quiet day in commodity land, although in the energy space, kind of a red day. So I'm talking first about precious metals, choppy for silver and a bit choppy for gold, but in the end, no real change to the GLD or the SLV. They're within a nickel or a dime of where they were yesterday. But look at the movements in crude oil and in natural gas. Both of those took pretty significant hits. As you'll see in a moment, the energy sector was actually the worst performer of the group. And I've had random questions in recent months about energy, just kind of checking in on, hey, is this the time to look at energy? And my standard response when I've gotten, so if you've asked this question, you've gotten a version of this response either in our mailbag episode or in a quick comment on YouTube. Two things I will tell you. Number one, we'll look at the chart individually, because not all energy stocks look the same. There are some that look quite strong, and things like pipeline companies have a huge dividend yield a lot of times. So I think that's a different thought process than something like Hess or Chevron, right? Those are more kind of oil, kind of big integrated oil companies. But the other thing I would say is if you're buying energy stocks here, and I'm not talking about like pipeline infrastructure, like natural gas stocks that are bucketed in with energy. I'm talking about like oil companies. You're betting on the price of crude oil. And from a technical perspective, the chart of crude oil is still pretty bad, right? Using our market trend model and applying that to crude oil, that's something I do every month, at least every month with our market trend, with our market misbehavior premium members. we apply our market trend model to oil, gold, Bitcoin, stocks, bonds, all those different things. Crude oil, bearish on all time frames right now, right? Short term, medium term, long term, it's in a downtrend. So until that changes, it's tough for me to justify buying an energy stock where that's going to generally go higher if crude oil prices improve. And I don't think that's a safe bet I'm comfortable making from a technical perspective at this point. Check out Bitcoin. Yesterday got up to around 89,000. Worth noting, it did not get above that big round number of 90K. It got close, but not quite up there, and did chop around there. It's currently around 86, 87,000 as we're going live here, just above 87,000 and change. We're down slightly from where we were during the show yesterday. Bitcoin actually rallied pretty good along with equities during yesterday's equity session. Today, more of a choppy, sloppy, net sideways, if not a little bit down kind of day. And you can see most of the top 10 cryptocurrencies on the stock charts platform in the red today. All right, looking at the 11 S&P sectors, we can see healthcare continuing to impress. I mean, hopefully you've been following as we've highlighted randomly over weeks, recent weeks here in the month of November. Healthcare just really surging to the upside. Out of the 4 defensive sectors, healthcare, utilities, real estate, and consumer staples. Healthcare by far the best performer out of that group in November. One of the better relative performers in the month of November, I would probably guess. The XLV leading today up 2.25%. Consumer discretionary, the XLY up 2.1%. Materials number 3 up 1.5%. You can see 9 of the 11 S&P sectors were down. Energy, as crude oil, natural gas prices were both down. Energy down the most, down 0.2%. Utilities down about 0.4%. Technology, third from the bottom, slightly higher, but the XLK once again underperforming the S&P 500. So even though we've had kind of this nice bounce, and even though I think everyone's kind of, or not everyone, but I'm certainly hearing some like super bullish vibes on, all right, boy, this is it. Buyable bounce, buy the dip is working. The fact that technology is not a part of this little uptrend party, for me would be a cause for concern if I was super bullish here. I'm way more cautious at this point until we see further improvement. But again, keep a watchful eye on technology for sure. All right, looking at the breadth condition, we can see advancers far outpacing decliners, in some cases by a significant amount. This was a great breadth day. And again, I don't have hard data on this, but the breadth's usually pretty good on a holiday week because most things are kind of generally higher. So 82% of the New York Composite Index were up today, 17% down. On the S&P 500, 85% to 15%. That's a 5-to-1 ratio. In the small cap space, 93% of the S&P 600 names were up. So obviously a bigger update. The smaller you get in the S&P indexes. And again, great breadth. I mean, this is encouraging. And what you'll find is some of the breadth indicators that we track regularly looking a lot less bad than they were going into this week. And I think that's something certainly to recognize. All right, the Magnificent Seven and Friends, as I think I mentioned yesterday, I did my weekly show on Stock Charts TV on Monday this week and did an episode where we literally went through this entire basket of stocks kind of one by one, but grouped them into 4 different buckets. The really good uptrend buckets like Alphabet and Apple, the really ugly chart buckets like Meta and Netflix, and then the others in the middle, testing, support. And one of the questions I had for my premium members going into this week, will those key mega cap names, Amazon and Microsoft, hold their 200-day moving average? For now, they appear to be doing so. We can grab the chart of Amazon. I mean, look at that. That was a Friday session where we traded right down to the 200-day, I mean, to the penny, to the 200-day moving average. And now Monday and Tuesday higher, bouncing above the 50-day. That 200-day holds. This is pretty, I mean, again, it's not the best chart I could find for you. I think there are other charts that are better technical structures, but that would be very encouraging because I think the bear case from here is that Amazon and Microsoft absolutely break below their 200-day moving average. Amazon holding it for now. Microsoft flashing kind of a hammer candle today and right at the 200-day moving average. This is what I mean about Microsoft. There's the hammer candle. Well, this is tough to see that, sorry, but we'll bring in a little more data here. Hammer candles where you have the open and close near the highs of the day. You have a limited upper shadow. This is small enough that I think it's still okay, and a long lower shadow. Look how we literally opened. We traded right to the 200-day moving average, slightly below. Buyers come in and push us back toward the highs of the day. Pretty good look for Microsoft and Amazon. Again, for now, holding their 200-day moving average. But look at NVIDIA, down 2.6%. And out of, if you're looking for things to not be excited about this week, I would say NVIDIA just really not moving any higher after earnings last week. We're still waiting. We're still waiting for that big surge of buying post earnings, which were obviously pretty decent, but we're not seeing it. Something to watch for sure. All right, let's look at the heat map here. Let's check out some of the individual names and groups and themes going on. As a reminder, I appreciate you so much tuning into the show every trading day after the close. I appreciate you dropping questions on our YouTube channel. If you have them, just use the comment section for that. Here on the heat map, NVIDIA down 2.6%. That's in the upper left corner of the chart. Kind of a tough way to start this. AMD, one of the other semiconductors, down 4.2% today. Two tough down days with the two largest semiconductor names that we would track, or certainly two of the biggest. After that, though, the rest of the technology kind of okay. The rest of the market, way more than okay, right? I mean, if you look, it's easier to focus on things that were not up, which is why I was immediately drawn to NVIDIA and AMD. On a big update, when the breadth was obviously very, very good and most stocks in the S&P were in the green, look for things that did not participate. That can often tell you something's going on. So Netflix, which again, I think more and more is becoming the least awesome chart. I think it's maybe overtaking Meta as the ugliest chart in the Magnificent Seven names. We could debate that between the two. They're both pretty bad, but in Netflix down another 2.4% today. Look at utilities, generally lower, energy generally lower. So that area, both those areas of the market, not looking particularly good. Technology is not bad. The problem is just, I mean, if you look at, you kind of separate technology into two halves, right? Take like the upper left half of the square and then the lower right half of the square. The lower right way stronger. It's the biggest names that were having the most trouble today. And while Broadcom, like ServiceNow, Applied Materials, Salesforce had up days, there were plenty of stocks within that kind of upper half market cap wise that were flat to down today. And that's what made technology third from the bottom in terms of performance. In terms of what worked today, I'm noting consumer discretionary. Obviously, we've talked about a lot of retail, and we've highlighted, even though, if you're nervous about the market, like don't count out the fact that Hilton made a new all-time high today. Don't count out the fact that what's another one? Definitely not RCO. What was I looking at before? Ralph Lauren, maybe? Ralph Lauren making new all-time highs today. So there are charts that are obviously looking quite good. Homebuilders are not making new highs, but they are breaking above, recent swing highs, right? They're kind of going from making lower lows and lower highs into starting to change a little bit. And that's something that definitely stood out to me as I'm reviewing the charts here. So a lot of consumer discretionary names looking quite strong. Healthcare continues to be probably our top area of focus. When I think about the 11 S&P sectors and where I've seen a critical mass of decent charts that are improving, that show strength, that show accumulation. It's in pharma, it's in biotech, it's in a lot of different areas of healthcare, most of which are in the green today. So I would encourage you to continue to reflect on exposure to that sector if you've not done so yet. Upper right, notice that industrials and consumer staples both had pretty good days. Within consumer staples, those are not generally great charts, compared to others. And I'm still waiting on a chart like Philip Morris, which has been in a consistent downtrend, but a reversal, this could end up being sort of an inverted head and shoulders kind of reversal. Kind of feeling that as I bring up the chart here, an inverted head and shoulders would be in a downtrend. And then you basically have a low surrounded by higher lows. Now there's this kind of weird aberration of a day here. This was on their earnings release. So I don't want to completely ignore that. So it's not the world's most ideal inverted head and shoulders, but if you think of that as a low and you look at some of these higher lows, you take the neckline between those extremes, certainly looks like we're breaking above it today, and definitely made a higher low around 150 on Monday's session. So maybe this is fine, forming some sort of bottoming structure, breaking higher here. I would say following through above the 200-day RSI, pushing above 60 for me is obviously pretty critical, right? Look at some in a downtrend, right? You have these bounces which immediately draw you in and think, all right, that's it. Philip Morris is a great chart again, but look at how the momentum never really gets into that bullish range. We want the RSI to look more like it did February, March, April, May, June, because in an uptrend phase, the whole momentum drifts higher. Here, we're still kind of in a bearish phase. So the momentum is telling us we're still in a downtrend. We move a little bit more higher. RSI pushes above 60. I would say you clear the 200-day for me. Like that's the signal that would say, all right, Philip Morris now showing clear signs of accumulation, kind of not there yet. All right. Not a lot of earnings, not a lot of economic data to break down this week, but one thing you can find all around you are Black Friday sales. Indeed, we have a Black Friday sale going for our Market Misbehavior Premium membership. I'll make a note to remind you about that at the end of the episode, because we've had a number of you that have opted in for that. I'm thankful for that. Seeking Alpha has been a partner of the channel for a long time. If you go to marketmisbehavior.com/alpha picks, you will find they are doing a Black Friday sale on their Alpha Picks product. This is where they use their quantitative model and apply it to a group of a bunch of stocks, thousands of stocks indeed, to look for stocks showing similar characteristics to previous winners. Then they hand select one or two every month and present them as an alpha pick. They dive a little deeper. I think it's a great way to illustrate using scanning and quantitative methodology along with deep fundamental and technical work to validate an idea. So I'm a fan of their approach, and you can get a really good Black Friday deal. They're running 20% off on basically all of their products here this week. By the way, you can also use my links to check out the other parts of the Seeking Alpha platform. I've been mentioning Alpha Picks this week, but if you just want to look at their premium membership, you can go to marketmisbehavior.com/seeking alpha, and you'll find a link to access a great deal on their premium membership. They also have a bundle where you get the premium membership and Alpha Picks all together. You can find that at marketmisbehavior.com/SA bundle. I'll put links for all of those in a comment on our YouTube channel. So if you want to check those out and go through them, any of the links you use are going to give you a great deal. Also help me to make Market Misbehavior awesome. So I appreciate you checking them out. And thanks again to Seeking Alpha for being a longtime partner of Market Misbehavior. All right, here, let's look at some charts together, shall we, to finish off our Tuesday, November 25th episode. S&P 500, I've been exchanging emails with a number of people, some longtime supporters of Market Misbehavior, some peers in the industry. If you've picked up on the idea that this almost looks like a head and shoulders top, you're not alone. I would tell you it's too early to be declaring this a big head and shoulders top. And what you're seeing, what your eyes are telling you is here's a head, here's a left shoulder, this is the right shoulder, and so we break below the neckline. And that would be it. And I think that last comment that I just made, and we break below the neckline, and that would be a confirmed topping pattern. Whether or not you call this a potential head and shoulders pattern, and I could see the argument, it's not ideal because you have this head, and then what happened here? Is this a right shoulder? This is some other thing. Is this the right shoulder? It's at best kind of a complex head and shoulders pattern potentially, with multiple right shoulders and multiple left shoulders. That is part of the technical analysis body of knowledge. That's a valid pattern, but whatever it is, breaking this line in the sand is crucial, right? Because until and unless you break below the neckline, whatever potential topping pattern you're seeing, according to technical analysis best practices, it's not valid. It's not valid until you break the neckline or break that trigger point. So for me, S&P 6550, the more we've tested this, the more that this looks toppy, it just further reinforces that a break below 6550 would be it. So I often ask about like what I'm thinking, how I'm positioned, right? So I think you have to remember there's a difference between here's what I think is probably going to happen and here's how I'm positioned. And I will tell you this. Here's what I think is going to happen. I think we go lower. I think we end up testing the 200-day moving average. If you ask me to say what's going to happen next, that's what I think is most likely. I could absolutely be wrong. Other people think the S&P is going to blow through 7,000 through year end. They may be right. They also might be wrong too. So I personally don't tend to be positioned based on what I think might happen and different scenarios I could lay out for you. I look at the trend. So for me, as long as the S&P is holding 6550, I still have plenty of exposure to stocks. So it's not like I'm all in cash and just praying that the market goes down using hope, which is a 4-letter word for investors. For me personally, I still have plenty of exposure to stocks. I have plenty of growth stocks that I have exposure to through ETFs that I'm holding right now. S&P breaks below 65.50, I'll probably start taking more action on that. I've lightened up in some cases and taken some risk off for sure, but I don't go full risk off until the chart really starts to break down. That, for me, as a trend follower, is an important piece of the puzzle to wait for, because that's the validation that a top is really playing out. And so 65.50 for me is a pretty important level. Again, there's so many things we've talked about that I think signs that suggest further weakness are coming. But again, from a trend analysis perspective, trend in the S&P is not bad yet. It's not great. It's probably okay. It's neutral, right? Is how I would generally describe it here. Here's the breadth in terms of the percent of stocks above their 200-day. This week, we have bounced off of the 50% level up to the 60% level. That might be one of the things, if we end up just ripping higher and blowing through 7,000, and if this whole bear idea is wrong, this indicator may be one I look back at and say, you know what, I have to remember to be patient as long as we remain above 50% of stocks above their 200-day moving average. I've mentioned that many times. And we got very, very close last week. We held it though. So I think breaking below 50% would be a pretty negative thing. For now, we're holding above there. I think that's good. Percent of stocks above their 50-day actually pushed just above 50% today. Ended the day around 52%. So if we can go into the holiday weekend above 50%, that's not a bad thing. So again, nice improvement in breadth this week. Have to acknowledge that. Now, with that improvement in breadth, you're also, excuse me, seeing a deterioration in volatility, or I guess a lowering in volatility. The VIX was up above 26 going into last weekend. It's currently down around 18.5. So the VIX has come down quite a bit. This looks a lot like the pattern that we saw in October with the big surge up to the mid-20s. This was during that pullback second week in October. We quickly recovered. The volatility came back below 20 and remained there, which is why that would be exactly what I'd be looking for here. If I'm bullish, I want the VIX to kind of generally be staying below 20. That would be an encouraging sign about a low volatility uptrend, which I think would be the ideal scenario for the bulls. 10-year yield continues to trend lower. Last week and really through the month of November is kind of sideways between 405 and 415. This week we are now breaking down. Bonds are starting to break out this week, and so the 10-year Treasury yield back down to 4%. It's basically the weakest levels that we've been in 2025. Back here at the April market low, we got down around 390, 385. Here in September and October, we got down to around 4%, 395. We're kind of right back to those lows. So I'd say we're at the point where the lowest point where the 10-year yield has been through the course of 2025. If this downtrend channel continues, stocks like or groups like homebuilders should stand to do quite well, because a downtrend in rates tends to be a good tailwind for homebuilders. And we're certainly seeing that here in the month of November. Offense versus defense. Let's look at the equal weighted version down here. We highlighted the fact that this has generally been trending lower since the end of Q3, right? Since the end of September, we're making a pattern of lower highs and lower lows. So we're bouncing higher this week as consumer discretionary is outperforming. For now, still potentially making a lower high and a lower low. We get above that point from late October. All of a sudden, that's not lower highs and lower lows anymore. That would be, a pretty bullish resolution to that pullback phase. So again, if we can continue to see offense outperforming, that would be a very encouraging sign as well, because defensive sectors have looked quite good in November. Here's the relative performance of the four kind of traditional defensive sectors: utilities, healthcare, consumer staples, and real estate. Each one of these series, excuse me, is showing the relative performance of the sector ETF versus the S&P 500. So if this line is trending higher, that means that sector is outperforming. And note that healthcare has been, I think the strongest of these four so far in the month of November. Utilities are actually pulling back this week, kind of in sympathy with technology stocks pulling back. And I wonder if that is tied, big selling point for utilities has been the idea that there's a bunch of energy needs of generative AI. And so they're kind of going to continue to do well as long as the AI trade is doing well. AI trade kind of struggling here recently, and so utilities struggling as well. But note that the rest of the defensive sectors, especially healthcare, are doing quite well. All right, bad news for NVIDIA is that was earnings, right? And that great earnings win, we gapped higher, and that's been it, right? We've generally been going lower since then. Now, today, we did close near the highs of the day. It's not a perfect hammer candle, but it's close. And it makes me think maybe through this shortened holiday week, we get a bit more of a bounce in NVIDIA. I would say looking into next week, the question is going to be similar to what we talked about before. Do we hold support at 164, 165? Does the RSI hold 40? For now, we may be, sort of treading water here, but keep an eye. But NVIDIA definitely not surging higher this week, while a lot of other stocks are. So if NVIDIA is not trading higher, what is? Here's GE Healthcare. GEHC was one of those spinoffs from GE. We had GEHC, GE Aerospace as the company kind of split up into and split off their different business units. I set an alert when I looked at this chart a little while ago, saw this resistance around like 78, 79, and was looking for a breakout today. That alert triggered as we pushed above 70, 79, got to $80, actually got up to 82 before closing at 80. I'd love to see a follow-through day, but maybe this is resolving to the upside and breaking out of that consolidation. Would be pretty encouraging for a key healthcare name. I mentioned the improvement in home builders. Here's the chart of Lennar. It did undercut its 200-day moving average earlier this month, but rotated back above there. We finally eclipsed the 50-day, and today that gap higher actually takes us above 130. I had an alert set for when Lennar breaks above 130. That triggered earlier today as well. Again, I'd love to see a follow-through closing above 130 to sort of complete that breakout. That would be a pretty encouraging resolution to Lennar. Other home builders kind of moving up as well. One of the questions I got on my YouTube channel, I just want to answer it today, Lululemon. And the question, if I boil it down to paraphrase, was something along the lines of like, when does Lululemon look good? And what would it take to have an attractive chart? And the follow-up comment was because the stores are so full, so why isn't Lulu doing better? So your question kind of had two parts. So there's often a disconnect between stores being full, the idea that there's tons of people buying Lululemon stuff, and the stock doing well. My favorite quote along those lines is, good companies don't always make good stocks. That is something that's sort of a Peter Lynch kind of approach. He would talk about like buy you what you know, look for good stories, look for good themes. But what I learned working with portfolio managers like Peter Lynch and many others at a big shop like Fidelity is that good companies, right? If you find a good company with a good story, good catalyst for growth, you also want the chart to tell you that it's a good time to buy it, right? That there's actually signs of accumulation. There's signs that the price is reflecting the optimism that you think is there. Otherwise, maybe we're missing something, right? Maybe something's not all good. The chart of Lululemon, the good news is it's not going down anymore, right? Remember, charts by my read can go one of three directions at any point. We can go up, we can go down, we can go sideways. Lululemon has been in a primary downtrend really since June. This was their June earnings report, I believe, where it kind of gapped lower. It might not be true. June, I think it was, right? I think it was that June report. Yeah, because there's the September report, and then they're set to report again here in a couple of weeks, beginning of December. So last two earnings reports, actually the last three earnings reports have not been particularly good. We've gapped lower every time. And this was the, since that June report, we just continued to trend lower. But after the September earnings miss, look how we found kind of a stable floor. We've bounced off of 160 about 2 weeks after the report, week and a half after we hit 160. We then bounced off of that level a bunch of other times here in the last 2 months. So the chart is telling you 160 is kind of the floor. Now, that's not saying we can't go below 160. We could, but from a technical perspective, the idea of support tells us buyers tend to be coming in at 160. So if I'm buying it here, that's kind of a natural stop, right? If I buy here and limit my losses to that previous low, and probably I put a stop just below there, then I'm saying I'm wondering if Lululemon's going to recover from here. And I want to play the potential upside, but I also want to limit my losses, which means as long as we hold that support as we have before, I'm not really losing too much. I don't have that much at risk, but I also have the opportunity to buy in low. Another way that you can approach this is something I talk about on Stock Charts TV when I do my monthly kind of chart review with Grayson Rose. We talk about different approaches on how to trade around different names. something like this, remember a partial position. Maybe you take an initial position thinking, all right, I think Lululemon's going to resolve higher. I'm going to take a partial position now, and then I would complete that position if we get above XYZ, whether that's getting above the previous swing high in October, whether it's filling this gap from early September, breaking the August high. That's more of a measure of risk and how aggressive you want to be with it. But thinking of it in stages and thinking about how you use the chart to manage your risk, thinking about where you might want to scale into a position, that's where you can really elevate your use of technical analysis. As we wrap up today, I will tell you this. If you want help looking at charts like Lululemon and figuring out how to use technical analysis to structure trades and how to think about technical analysis to manage risk and how you can improve your market awareness by having a good, consistent process built in technical analysis and behavioral finance, check out our premium memberships. We're doing a Black Friday sale this week. You can go to marketmissbehavior.com/premium. Make sure you use the code SPXDAVE. That's SPXDAVE when you check out. I'll get you 40% off your first 12 months on any plan. We have monthly and annual subscriptions. I would encourage you to check out the annual subscription because this is about as inexpensive as you're going to find it here for another 12 months. So great opportunity to lock in a pretty low rate for the year. Great opportunity to really take whatever you've learned until now and move yourself meaningfully to that next level. That is my goal for my premium members. I'd love to have you join up and see some improvements as well. Go to marketmissbehavior.com/premium. Don't forget to use the code SPXDAVE when you check out for 40% off your first 12 months on any plan. Folks, that'll do it. Thank you so much for supporting me and Market Misbehavior. I'm still getting over the cold, but I'm feeling a lot better, so that's good. But I'll keep healing up and enjoying time with the family. I am thankful for all of you joining me. Hope you have a lot to celebrate. Happy anniversary, honey. 25 years is awesome. For Market Misbehavior, I'm Dave Keller. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.